The market's future might be uncertain, but one investment is standing out as a steady winner: SCHD. Welcome back to the Prosperity Pulse Point. Today, we're talking about a smart and reliable investment for 2025, the SCHD, and why it might be one of the best places to put $25,000. SCHD has been a standout performer for years, offering steady growth and a solid dividend yield. Over the last decade, it's delivered an impressive annual return of more than 11%, all while keeping volatility low. In 2025, with the market's uncertain future, many are turning to dividend ETFs like SCHD for their mix of stability and income. But what makes it such a great choice for your money? In this video, we'll break down SCHD's strong track record, its potential for 2025, and how investing in it could help you grow your wealth with minimal risk. Stick around as we uncover why SCHD could be the smartest investment you make this year. Chapter 1: SCHD's Historical Performance and Consistency. Let's start by taking a look at how SCHD has performed over the years. If you're looking for a long-term investment that can withstand market fluctuations, SCHD stands out. Over the past decade, it's averaged an impressive 11% return per year. That's not only above average, it's a solid track record, especially for a dividend-focused ETF. And it doesn't stop there. Over the last 5 years, its return has been even higher, at around 12% annually. These numbers aren't just random. They represent consistent, reliable growth. What's even more impressive is SCHD's ability to generate passive income. With a dividend yield hovering around 3.5%, SCHD offers a solid payout. And that's not just a one-time thing. This ETF has consistently raised its dividends year after year, making it a great choice if you're looking to build a stream of income. Now, you might be thinking, but what happens during market downturns? That's where SCHD truly shines. During the 2022 bear market, while major indices like the S&P 500 lost over 20%, SCHD only dropped around 3%. That's a huge difference. In fact, it's been one of the better performers during market volatility, showing its strength during both growth periods and downturns. This level of consistency, both in returns and dividends, makes SCHD a compelling option for investors looking to balance growth with stability. It's not about chasing the highest returns. It's about sustainable, long-term wealth building. Chapter 2: SCHD's Investment Criteria and Market Advantages. Now, let's dive into what makes SCHD a unique investment. It's not just about the performance. It's about the strategy behind how SCHD picks its stocks. The ETF follows a very specific set of rules when choosing its holdings, and this strategy is one of the reasons why it's so reliable, especially in uncertain markets like the one we might see in 2025. First, SCHD focuses on companies that have a solid history of paying dividends. Only companies with at least 10 consecutive years of dividend payments are considered. But it doesn't stop there. SCHD also looks for companies that have increased their dividends for at least 5 straight years. This gives you a sense of stability because these companies aren't just surviving. They're thriving and sharing their profits with shareholders. Another key factor in SCHD's stock selection is financial strength. It uses measures like free cash flow to total debt ratio and return on equity. These metrics ensure that the companies it invests in are not only paying dividends, but are financially healthy and capable of weathering tough times. This is critical if we end up in a recessionary environment in 2025, which some analysts are predicting. SCHD's portfolio is also tilted toward defensive sectors like healthcare, consumer staples, and financials. These industries tend to hold up better during economic slowdowns because people still need healthcare, food, and financial services, regardless of the economy state. For instance, SCHD has a significant portion of its holdings in healthcare and consumer staples, sectors that historically perform well when the economy slows down. In comparison to growth-focused ETFs like QQQ, which are highly exposed to tech stocks and tend to do well in a booming economy, SCHD's focus on value stocks with consistent dividends positions it as a safer bet for 2025, especially if the market turns more volatile. Chapter 3: Projections for 2025 and Economic Context. As we look ahead to 2025, one of the big questions for investors is, what should you realistically expect from SCHD? Based on current market conditions and analysts' predictions, SCHD seems well positioned to deliver steady returns, even in uncertain economic times. Let's talk numbers. TipRanks, a leading investment research platform, sets the average 12-month price target for SCHD at around $313 per share. That's about a 9% upside from where it stands today, not including dividends. Now, that may not sound like explosive growth, but remember, SCHD isn't a high-risk, high-reward stock. It's a value-focused, dividend-generating machine. When you add in its 3.5% dividend yield, total returns for 2025 could be closer to 11% to 12%, assuming the market remains stable. Here's the twist. 2025 might not be a normal year. We're facing potential economic challenges, including the possibility of a recession. The Federal Reserve has been hinting at rate cuts, which could signal slower growth and higher market volatility. This makes SCHD's defensive nature even more appealing. As a value-focused ETF, SCHD is less vulnerable to the market swings that growth-focused ETFs like QQQ might experience. In fact, if we do see a market slowdown or recession, SCHD's focus on stable, dividend-paying companies puts it in a strong position to hold up better than riskier growth stocks. Remember, in tough economic times, investors flock to assets that provide steady income, like SCHD's consistent dividends. However, it's important to consider that even the most stable investment can face short-term challenges. A downturn could push SCHD's price lower, but even then, its dividend income would likely help offset losses, keeping it attractive for long-term investors who are focused on wealth building over several years. Chapter 4: SCHD versus Alternatives. When comparing SCHD to other investment options, it becomes clear why this ETF is a favorite for 2025. Its blend of high dividend yield, low volatility, and consistent performance places it in a category of its own. But how does it stack up against alternatives like QQQ, JEPI, or even individual dividend stocks? Let's start with growth-focused ETFs like QQQ. QQQ has been a star in recent years, driven by tech giants like Microsoft and Nvidia. However, tech-heavy ETFs thrive during bull markets, and 2025 is shaping up to be a more cautious year. SCHD's focus on value stocks gives it a key advantage in this environment. Unlike growth ETFs, which often reinvest earnings to fuel expansion, SCHD prioritizes paying and growing dividends, providing a reliable income stream even in choppy markets. What about other dividend-focused ETFs like JEPI? JEPI offers higher immediate income, but at the cost of long-term growth potential. SCHD strikes a better balance, combining a 3.5% yield with sustainable growth over time. Finally, investing in individual dividend stocks can be rewarding, but it requires significant research and carries the risk of single stock volatility. SCHD, on the other hand, provides instant diversification with 100 holdings spread across defensive sectors like healthcare and consumer staples. While each option has its merits, SCHD's low expense ratio, defensive positioning, and consistent payouts make it a standout choice for those seeking both stability and growth in 2025. Chapter 5: Strategies for Investing $25,000 in SCHD. Now that you're convinced SCHD is a strong contender for 2025, Let's talk about the best way to invest your $25,000. The strategy you choose can have a big impact on your long-term returns, so it's important to think about your goals and timeline. One of the most straightforward ways to invest in SCHD is through a lump sum investment. This means you'd put your $25,000 into SCHD all at once. If you're confident in the ETF's stability and want your investment to grow over the long term, this could be a solid approach. However, if you're worried about timing the market or the possibility of short-term dips, a lump sum investment can feel a bit risky. That's where dollar cost averaging, or DCA, comes in. DCA is a strategy where you invest a fixed amount regularly, regardless of the market's ups and downs. For example, instead of investing all $25,000 today, you could invest $2,000 a month for the next year. This smooths out the impact of market fluctuations and reduces the risk of buying at a peak. Over time, DCA helps you buy more shares when prices are lower and fewer shares when prices are higher. Another advantage of DCA is its emotional benefit. It takes the pressure off trying to time the market perfectly. Plus, you get to build your position in SCHD gradually, locking in those consistent dividends along the way. If you're investing through a tax-advantaged account like an IRA or Roth IRA, you'll be able to maximize the benefits of SCHD's dividends without worrying about taxes. In a Roth IRA, for example, all dividends grow tax-free, giving your investment an extra boost. Whether you choose a lump sum or dollar cost averaging, the key is to stay committed to a long-term strategy. SCHD's combination of growth and income makes it an ideal ETF for building wealth steadily over time. So if you're looking to secure your 2025, SCHD might just be the investment to help you get there. Thanks for watching. And if you found this video helpful, don't forget to like, comment, and subscribe for more investing insights.